Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 142 on November 28th, 2020. I'm your host, Eric, and in this week's show, we will cover the trades from last week on Inovio Pharmaceuticals, the SPDRs Oil and Gas Exploration and Production ETF, and the SPDRs Gold Trust ETF. And we discussed three new trades on Michaels Companies, Kroger, and Bausch Health Companies. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show, or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, what a week we had, right? It's crazy for a holiday week. On Tuesday, we saw the highest closing value of the Dow Jones ever, closing above 30,000 points. And this week is still ending on the highest weekly close, the highest weekly closing price we've seen in the U.S. equity markets. We're higher than we were back in February when we hit those highs. So the Dow Jones Industrial Average gained 646 points this week, closing at 29,910 points. The S&P 500 index picked up 80 points, ending the week at 3,638 points. And as I thought about what to talk about for the topic of the week, and obviously it's time for the topic of the week, but as I thought about that, people ask me all the time, like, are you looking to buy right now or are you looking to sell? And I'll answer that here shortly, but actually, you know what? I'll answer it now. Yes to both those questions. I am looking to sell the market. The market cannot stay high or push for new highs over and over and over again without having some sort of correction, and I think we're due one. So the way I'm looking at selling the market is to buy a put looking at January or February, something along those lines. So I'll simply buy a couple of put options, or maybe I'll start to build a position in put options. That makes sense. I'm not going to spend a lot of money on them, meaning I'm looking for puts that are going to be lower delta, probably under $100 each, or around $100 each. I'm not buying the $1,000 at the money puts. I don't see that as becoming the best. I don't think that's the best use for your trading dollars. As well, would I suggest shorting this market? No way. If you said, Eric, how are you going to position your money right now? If you had to either buy, the S&P ETF or the Diamonds ETF, or sell it this week, and those are the two that I like to use the most for overall market movements. I'm not going to sell this market right now. There's nothing stopping us from going higher. We seem to be going higher on limited data. So what's going to keep us from, what's going to make us not suddenly go any higher? But do I think we can stay high forever? No. And I think January is always an interesting month. January oftentimes, we call it the January effect, right? We expect the market to have a strong entrance. But what's different this year, of course, is that we have a new president coming into office. We also have this coronavirus and people that are, we've got some states and some cities that are looking to shut down, even going into the Christmas holiday. So that right there is enough of a reason for me to consider buying puts. But by no means would I just short this market outright, because I think it could go higher. Who knows? I certainly don't. But the topic of the week that I intended to talk about is using momentum in trading. Now, when I worked on the trading floor, we would always use phrases like "don't catch a falling knife," and we talk about stepping in front of a train, right? And those phrases ultimately were talking about market momentum. So in layman's term, Momentum is simply market price strength in a focused direction, right? There are all sorts of reasons why momentum happens. It's like someone yelled fire in a movie theater and everyone's pushing through one single door, with the strength going. As the market moves in a single direction and more traders head for that door, they add strength in that direction, whether it's going up or down. And you'll see speed and strength for both corrections and for trends. So we saw a correction this week in Bitcoin's price. It fell $3,000 in a couple of days after weeks of a trend that was pushing the market higher. So momentum can do all sorts of things. If you watch the equity markets, obviously the push higher to make a new all-time high this week was done so with some momentum. So my goal is always to trade with momentum. I look for trades that match the market momentum. And it's best when that momentum is also in the direction of a pre-established trend. So I'm not really the contrary or contrarian investor. I've been contrarian in the past and it's cost me money. So even when I say that I expect the market to go lower, notice that I'm looking to take a position that has limited risk, right? I'm looking to buy puts rather than just going in and saying I'm going to short the S&P futures on Monday. I will not be doing that. So I look for momentum to support the pre-established trend. And I use a couple of momentum indicators that are built into trading platforms or trading charting systems that I use. So the two I like to use are the RSI, the Relative Strength Index, and I think I've spoken on here about the Moving Average Convergence Divergence indicator, otherwise known as the MACD. Both of these give you a visual representation, like a graph of which way market momentum is heading. And I'll likely teach more about those soon, but those are two that I like to keep an eye on. And they're fairly common, so chances are you'll see those in your own charting software. So let's go ahead and dive into the review of last week's trades. It was a good week, which is very interesting because I both sold a put spread and bought a put spread. And you would imagine that that one of those would have been a win and the other would have been a loss, but I'll explain more as we talk about it. So our covered call last week was on Inovio Pharmaceuticals, symbol INO, I as in India, N as in November, O as in Oscar. At the time, the stock was trading for $10.54, and we looked at buying stock and selling the December 11 call at $1.24, hoping for a maximum return of 16% in 4 weeks. Well, shares of Inovio Pharmaceuticals rose $1.72 this week, finishing the week at $12.26 per share. The call option we sold gained $1.02, leaving us with a net profit of 70 cents if you were to exit the trade right now. Of course, if you allow this trade to expire in the money or wait for someone to exercise that call option, you will actually lock in a profit of $1.70 for this trade. So either way the trade worked, no adjustments are needed at this point. Gotta love it when those type of trades work, covered calls. Next up, we have the credit spread. I looked at the S&P Oil and Gas Exploration and Production ETF, symbol X as in X-ray, O as in Oscar, P as in Papa. At the time, the stock was trading for $52.06, and I looked at selling the December 52.51 put spread at 41 cents, which could give us a maximum possible loss of 59 cents per spread. Well, the XOP ETF grew $5.82 this week, closing at $57.88 per share. The out-of-the-money put spread we sold is now even more out of the money, and the spread can be bought back for 26 cents, which would allow you to lock in a 15 cents gain for the week. That's roughly 36.5% gain on your money for the week if you were to close the trade out. Of course, if prices remain high for the next 3 weeks, we'll get to keep the full premium that we collected for selling the spread. That's a 41-cent gain over the next 3 weeks if we hold on to this trade and stock stays higher. So I would lean towards staying short the spread rather than just buying it in immediately. The market right now is $5.88 higher than your short strike, which is a good thing. So of course you have to stay alert, but this trade is a winner as well, and any adjustments like selling a call spread against it could lead to a loss. So no adjustments needed. I would just keep an eye on it, and I'll be watching it and deciding whether or not I need to buy it in or just let it expire, ideally for a zero. Our final trade from last week was a debit spread. We looked at the S&P Gold Trust ETF, symbol G as in golf, L as in Lima, D as in Delta. At the time, the stock was trading for $175.69 per share, and I looked at buying that December 177-176 put spread. So this is the put spread I said we bought, paying 60 cents, which could give us a maximum gain of 40 cents or 66.67% return in 4 weeks. Well, the gold ETF lost $7.79 this week, closing at $167.90 per share. The in-the-money put spread we bought is now even more in the money. And you could close this trade out for a gain of 15 cents if you wanted to go ahead and sell it. But that would represent a 25% return on your capital in 1 week, so not bad. Of course, if you hold the trade through expiration, assuming that stock remains higher, you'll gain the full 66% return on your capital. So some of you might be happy to make 37.5% of your upside and take it off the table on a 1 week trade. It all really comes down to how you like to manage your open risk. As long as you own the trade, meaning it's open, you can't really count the profit. You only count profits when you close the trade. But for this one, I intend to stay put, pun intended. I know it's a bad joke, sorry. But I'd stay in this trade. And the main reason, so last week I looked at selling a put spread and then buying another put spread. And what you see here is a classic example of selling a put spread against the oil and gas ETF. And that oil and gas ETF climbed a lot higher along with the overall market. So we were able to make money on selling that one. And then you see a sort of counter-cyclical trade, the owning of the put spread with gold. So gold, as the equity markets went higher, gold actually came off. And so with that, owning that put spread actually paid us well too. So I normally am aware of whether I've bought calls and sold puts or sold calls and bought puts as far as the spreads go. This week it just happened to they happened to both work out. So always a good thing. So let's go ahead and dive into the new trades for this week. And as usual, we're going to start off with the covered call. Of course, all of these trades have 3 weeks. We are 3 weeks away from December expiration. So we'll probably look at December trades as well for next week. And then that following week, we'll go ahead and start eyeing January, the month of January expiration. So the covered call this week, we're looking at the Michaels companies, symbol M as in Mike, I as in India, K as in Kilo. The stock ended the week at $10.24 per share. I'm looking at buying stock and selling the December 12.5 call at 35 cents, hoping for a return of 25.5% over the next 3 weeks. And most of that return, just as an FYI, would be coming from the stock increasing to get on up to that 12.5 strike. So you enter this trade by buying stock for $10.24 and selling the December 12.5 call at 35 cents. This trade makes the most money if stock prices finish above $12.50 per share. Our break-even price is $9.89 per share. In real terms, the stock purchase would require $1,024, and you would collect $35 for selling the option. Our next trade on the week is a credit spread. Looking at Kroger, symbol K as in Kilo, R as in Romeo. The stock ended the week at $32.43 per share. I'm looking at selling the December 32 call spread at 17 cents, which can give us a maximum possible loss of 33 cents per spread. Now you enter this trade by selling the December 32 call at $1.10 and concurrently buying the December 33 call for 93 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices finish below $32.50 per share. The break-even price on this trade is $32.67 per share, and in real terms, you would receive $17 per spread that you sell and have $33 at risk. And then our final trade on the week is a debit spread. Looking at Bausch Health Companies, symbol B as in Bravo, H as in Hotel, C as in Charlie. Stock ended the week at $19.53 per share. I'm looking at buying the December 19 call spread for 34 cents, which should give us a maximum gain of 16 cents or 47% return on your capital in 3 weeks. Now you entered this trade by buying the December 19 call for 97 cents and concurrently selling the December 19 call at 63 cents. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices stay above $19.50 per share. The break-even price on this trade is $19.34 per share, and in real terms, you'll pay $34 to enter the spread, and your maximum gain is $16 per spread. So that's it for this week's show. Thank you guys so much for listening as usual. I love getting email. I've gotten so much email lately, so thanks for that. I'm also going to host a small trading class soon. So for those of you that are interested in learning some more about option trading, there'll be a lot of one-on-one time as well as some group training and video online courses. So just shoot me an email if that's something you might be interested in, and I'll give you more information about the upcoming class. So that's it. I hope you guys have a happy week. If you're in the U.S., I hope you had a wonderful Thanksgiving. And until next week, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.